Good morning and welcome to Economy and Market on BusinessDay TV, where we give you a comprehensive insight into the economy as well as matters affecting the capital markets. On the show this morning, we have a discussion around the acquisition of a 40% stake in a company known as ND Western by one of Nigeria's listed upstream oil and gas players, that's Aradel. Aradel last week acquired an additional 40% stake in ND Western, increasing their stake to 81.67%. This is the latest in the list of mergers, acquisitions that have been dominating the upstream space in Nigeria. And in addition to that, we also have reports coming in from Renaissance Capital Africa that there will be further divestments on onshore assets, that is shallow water assets, by next year. They outlined around 10 oil blocks that they believe that some of the IOCs are probably going to be letting go of, and we want to look at it holistically. We want to look at the entire thing. What's the implication for the entire space? And on the show this morning, I have Dipo Oladehinde, our energy analyst here at BusinessDay. Good morning.
Yeah, good morning, David. Nice to be here once again.
Yeah, so let's start with the Aradel deal. What's the rationale behind Aradel's acquisition of this new equity in ND Western?
Okay, thanks. So again, you need to look at the objective of Aradel. What is Aradel trying to achieve? What's their end game in all of this? Are they trying to the first acquisition of assets where they are a player in the Renaissance conglomerates? Is it a one-off thing, or they plan to spread their tentacles across the Nigerian market and then of course expand to West Africa? So what we've seen is Aradel is expanding. They are trying to grow their influence across Africa and across Nigeria, because first of all, they are seeing opportunities. They are seeing plans for expansion, for growth. Why? Because if you look at Nigeria, for the first time in a long while under the new administration, we are seeing an improved environment around the oil and gas sector.
Okay.
So we're seeing a lot of deals happen. The ease of doing business in the oil and gas sector have relatively improved now. And so, I mean, you'd ask yourself, what's better time to strike than to strike when the iron is hot? So they probably saying that the iron in the oil and gas sector is hot, and they are striking because they are seeing opportunities for growth.
Okay.
Not just within the areas where they already have control over. They are seeing opportunities for growth in other areas, and they probably looked at the Renaissance conglomerate and say, look, why don't we try to acquire more
stake in what we have now?
In what we have now. First of all, you look at the environment. So first of all, we have the NNPC boss, who is a private sector person, somebody who they are very, very much familiar with. You have the special advisor to the energy, Olujinmi, who is also spearheading a lot of reforms as well. So, I mean, you look at the sector, and the best time to strike, if you have any money that you don't know what to do in the short term, I think the best time to do now is to look at the oil and gas sector and
look at where it can enter.
So
one question is around ND Western. ND Western has a 45% stake in one of the OMLs, that's OML 34.
Mm-hmm.
How will it affect Aradel's reserve profile right now? For now, we know that I think Aradel only has stake in is it Ugbele? I think that's OML 12. Now, how will this play into what they have existing in their books for now?
Okay, so the game of the oil and gas is a game of reserve, really, because reserve fits into your production.
Yeah.
And the bigger your reserve is, the bigger your ability to. There's a metrics called reserve replacement ratio. Reserve replacement ratio is as you are producing from your reserve, you're expected to be refilling back those reserve, because you are only as big as what your reserve can do.
Yes.
Really. It's if you want to see a company's production profile in the next 3 or 4 or 5 years, go and check their reserve. It's whatever they have there from their reserve,
they can use to get loans and all.
Exactly. And so the bigger your reserve is, the bigger your ability to. You can walk into any bank and say, look, I need $500 million, and you say, What's your
What do you have?
collateral? I'll show you my reserve. You can walk up to any major financial institution. You can even walk up to any of the big players. If you want to collaborate with a Shell, for instance, you want to collaborate with any of the biggest technical partners, your ability to, the bigger your reserve is, your ability, the bigger your negotiation skill is, the bigger. So what they are trying to do, which I also foresee they will do more, is they will try to grow their reserve because they want to increase their reserve replacement ratio. And so the bigger your reserve, it's when your reserve is growing, then you can now talk to partners who can help you scale up oil production. And then it's, again, I think the companies, they are thinking big. They are probably looking at their 10-year, 15-year. Let's acquire as many short deals as we can now. So beyond just ND Western, they'll probably be targeting any low-hanging fruits, especially assets that they've discovered that they are big on gas and they have their oil production. They've not really fully explored all of the oil in it. So they'll probably be going for that and then scale it up, boost your reserve. When you boost your reserve, you can get more funds in order to scale up oil production, and then you're bigger.
So basically, we are looking at a bigger Aradel in this sense. So Aradel will have not just OML 12, they also have OML 34. The question I have is around Renaissance. There's been a lot of talk around increasing their stake in Renaissance. Before now, they had a 12.5% stake, direct stake. Then when you consider what they hold in ND Western, I think their indirect stake now goes up to 20%. But now people are saying it's going to go up to 50%. Their stake in Renaissance. Give me a feel of how that does that now give them like effective control over whatever goes on in Renaissance?
Okay, so I had once interacted with someone with Aradel and who had said to me that, look, Aradel's goal is to be the king of onshore assets. That's the end goal. So they want to basically dominate all the onshore assets in Nigeria. So that's which is why I said, look, it's not, I think this is just the beginning. And let's not forget that in the oil and gas sector, it's still, we are coming from a very low base. That's apart from Seplat.
So that means they're going to be in direct competition, like massive competition with people like Seplat.
Yeah, of course, definitely. So again, apart from people like Seplat, who else is? We look at ITO, for instance. Yes, ITO is big in the name, but then they've just been able to focus on the assets they've acquired ever since they came on board, and that's what they've been maintaining.
Yes.
You look at others. You look at
Sterling Oil.
You look at New Cross. You look at. I mean, what Aradel is trying to do is again, look at the people behind the Aradel structure. Yeah, ex-IOC guys, people who think that, look, the oil and gas is not well developed, so they're trying to do more regarding it. So back to Renaissance. So their control of Renaissance is, they are upping their stake in control of Renaissance. Let's not forget that Renaissance hands are completely filled up now.
Yes.
You've acquired about 20 to 25 assets from Shell. This is just oil blocks ago. Their oil wells are there. You look at gas plants are there. You look at a lot of things, pipelines. So the Renaissance, all the assets under Renaissance is, I mean, it's massive. So what Aradel is trying to do is they want to have a bigger slice of the pie. And what better way to do that than to acquire more stakes from people who are willing to let those stakes go. And again, you just need to look at the vision. Normally, if you have a stake in Renaissance now, it's expected that you would hold tight to it because but then, I mean, it's often said that everybody have a price. Even if you have a stake there, there's some amount of cash that will be dangled at you, and you say, okay, look, I think this cash is convincing. Let me let go of. So that's what they are doing. They want to acquire more stake in Renaissance because they see future in onshore assets in Nigeria. And so if the end game is to be the king of onshore, I foresee that they would be acquiring more till when they are coming through.
Now, that leads to my next question around the reports that Renaissance Capital Africa wrote and the one you reported about, that they are highlighting that around 10 onshore assets will be divested by 2026, maybe 2027. What's the rationale? Why is it happening this way? Especially an NPC that wants to let go of some of his onshore assets. Why are they doing that?
Okay, so for the 10 assets that will be up on the market next year, majority of these assets are owned by IOCs that they are under pressure from international communities to reduce their carbon emissions.
Okay.
Their majority of them, their headquarters are already on their. So IOCs are basically prioritizing assets that are not, the carbon emissions from these assets are very low. And so once they realize that, look, it will affect the group's ability to make money, or to the group's ability to raise cash, they'll probably let go of those assets. So that's one. Again, it's often said that indigenous guys can sweat onshore assets more
better
compared to
IOCs.
IOCs. That's secondly. And then thirdly, again, you look at the oil and gas sector, there's been some executive orders lately that has basically changed the game for the oil and gas. So now there's executive order on project cycle. So what that means is a project have a timeline. If you initiate a project with the regulator, you have a 6-month window to close that project. Before now, you can initiate a project and the project can take forever with nobody listening to you. But now there is a law that says the regulator must attend to you within 6 months. So that puts the regulator under pressure to say, look, if you submitted a project to sweat one asset for, maybe you want to increase production by 10,000, there's a law now that says the regulator must give you speedy reply within 6 months, even if they are not, and that is what is needed really in the sector. Because the sector is not saying the regulator should say yes to every operator's demand. Yes. But the law is saying give a response. So even if you are saying a no, it means that the operator of that asset can easily move on from that asset and go and do whatever he or she needs to do in order to make sure that the asset is viable. So what we are saying is this is the best time to put in your money in the oil and gas, because there is certainty of funds. The certainty that you will recoup your money back is there. And so why not? Because again, you don't know what will happen in the next 4-5 years. You can have a new sheriff in town that won't pay as much attention to the oil and gas, the way the Tinubu administration is paying. So everybody is trying to say, look, what can we do in order to make the best of what we have right now? So the divestment would happen because, again, some indigenous guys who already have access to 1 or 2 cash, or who can talk to banks, especially the local banks. Again, some of the local banks are open to investing in the oil and gas now because they've also seen green lights. So if they can talk to local banks, they can raise cash, and then the more cash they can raise, the better they can do business, and that's it.
So the question I have now is around the competitive advantage of the local guys compared to the IOCs. You said they have the ability to sweat the assets more. Based on what? Is it the ability to interact with the communities better?
Yes. So again, onshore assets are assets that are within communities, within the ground level. And so the indigenous guys can sit down with majority of the global guys. The IOCs can't do that because of international laws that they are obligated to, right? Majority of the IOCs cannot have there are some agreements they cannot reach with host community, even if they would want to, but because it's against their parent company's policy, they won't want to. For instance, the local guys can be flexible in their interactions with the host communities and say, look, what are the demands of the host community? Is it to sponsor, again, this is just example, is it to sponsor Ashore for you guys every month?
Okay.
And that will guarantee steady power. If that would, of course, they are willing to enter all sorts of negotiations
to prevent them from sabotaging operations.
Exactly. But the international company will probably tell you, no, this is against my parent company. This is, again, the international companies, they don't understand our peculiar challenges in Nigeria. They don't understand the peculiar challenges facing each of the host community. For one host community, the problem facing them might be insecurity. For another one, it might be issues of potable water. For another, it might be issue of good schools. For another, it might be issue of just taking care of their chiefs. There are some traditions in Nigeria that, look, they'll be loyal to you if you take care of the elderly ones in their environment.
Yeah.
Right? So once you take care of the elderly ones in their environment, that's all you need. You have their 100% loyalty. And so if it means taking care of the elderly ones in that community, you would earn peaceful. Yes. So the local guys will be more flexible in how they negotiate.
Yeah.
The local guys have a better understanding of the local environment compared to the international guys. And the local guys are more flexible, right? They can tweak whatever agreements they need to have with host community in order to achieve better oil. So that's what I say. They can sweat the assets more. They can they can interact more. Let's not forget that even when the IOCs are operating in Nigeria, they had intermediaries, right?
Yes.
That they are dealing with in order to interact. And so rather than dealing with this community, the local guys can sit down with the elderly
The
man in
elderly
one
one,
community and
yes,
say, look, let's eat fisherman pepper soup. What are your
together. What
demands?
are your demands?
What do you want? How can we make things better? And that's it. And that's what we would achieve.
Okay. Thank you so much for enlightening us, giving us insight into what the implications of some of these continued M&As are for the upstream sector. After the break, we return with market updates making the rounds as well as some news highlights. Stay with us. Welcome back to Economy and Market, and we're moving on to business news making the rounds. CBN says that the $1.25 billion Q1 oil support import bill is not a direct intervention. The CBN has said that the amount represents legitimate foreign exchange transactions conducted by participants in the Nigerian foreign exchange market, not direct CBN intervention. According to the CBN spokesperson, Hakama Sidi Ali, the figure reflects total FX transactions across sectors, including oil and gas, under the willing buyer, willing seller framework. She explained that since the unification of exchange rates in 2023, the NAFEM has operated a market-driven system where forex is sourced and supplied by market participants, not allocated by the central bank. Ali emphasized that the data published in the CBN's Q1 2025 sectoral utilization of foreign exchange report simply captures aggregate utilization by authorized dealers and end users. The bank reaffirmed its commitment to a transparent market-based foreign exchange regime that promotes efficient price discovery, economic stability, and confidence in Nigeria's financial system. They'll move on to a bill that's being proposed by the House of Representatives. The House of Reps is proposing a green tax on plastic manufacturers to curb pollution. The House of Reps ad hoc committee on the ban of single-use plastics has proposed a green tax on manufacturers of polypropylene, a plastic widely used in packaging, disposable cups, woven bags, and household items. At the committee's inaugural meeting in Abuja, the chairman, Tessar Ugbo, said the House will also consider legislation to regulate polypropylene production and promote recycling as part of the national strategy to curb pollution and protect public health. He warned that polypropylene emits toxic chemicals like formaldehyde and benzene during production, contributes to high carbon emissions, and can persist in landfills for up to 500 years. Ugbo said the committee will work with the Environment Ministry and NESRA to design a policy framework for the green tax and integrate recycling into national waste management. He emphasized that the initiative is about sustainability and environmental responsibility, not taxation, as Lagos State also enforces its own plastic ban. Then we'll move on to news around Nest Oil. Police has sealed Nest Oil headquarters as court order takeover over a $1 billion debt. Armed officers of the Nigerian Police Force on Tuesday sealed the Lagos headquarters of Nest Oil Limited following a federal high court order authorizing First Bank of Nigeria and its subsidiary, FBN Quest Merchant Bank, to take over Nest Oil assets over an alleged debt running into $1 billion. The enforcement followed a Mareva injunction issued on October 22, 2025 by Justice D.I. Dipo Oladehinde against Nest Oil, its affiliate, Nekonde Energy Limited, and the firm's promoters, Ernest and Nnenna Obie Jesse. The court directed the Deputy Inspector General of Police to assist bailiffs and the appointed receiver manager in executing the order. Court filings show that FBN Quest Merchant Bank and First trustees alleged a combined debt of $1.01 billion and 430 billion naira as of September 30, 2025. The ruling also freezes accounts and shareholdings in more than 20 financial institutions. The case was adjourned to November 7 as Nest Oil and its chairman are yet to respond. Nestle hit 72.5 billion profit in 9 months as higher prices boost revenue. Nestle Nigeria PLC has reported a net profit of 72.5 billion naira for the first 9 months of 2025, marking a sharp rebound from the 184 billion net loss recorded in the same period last year. Revenue rose by 33% to 884.5 billion, driven by higher product prices, while gross margins improved to 37% from 31% in the first 9 months of 2024. The company's turnaround was largely supported by a 20.8 billion net foreign exchange gain, reversing a 285.3 billion FX loss in the same period of 2024. Its net finance cost dropped to 53 billion, reflecting improved FX market stability and the ease of pressures on import-dependent manufacturers. Pre-tax profits surged by 150% to 128 billion, while its earnings per share stood at 91.44 naira. However, the Q3 profit margin fell to 7.2%, while the 9-month average was 8.2%. Nestle reduced its total borrowing to 521 billion, maintaining a stronger, more efficient balance sheet. Then we move on to news around GT Co that has reported a net interest income of 952 billion in the first 9 months of 2025. GT Co, Guarantee Trust Holding Company, has reported a 22% rise in its net interest income to 952 billion naira for the first 9 months of 2025. This is driven by higher yields and sustained asset growth. Interest income from consumer loans rose to 450.8 billion, while investment securities contributed 547.8 billion. However, interest expense increased by 40% to 278.7 billion amid tighter monetary conditions. Non-interest income grew by 17% to 210 billion, supported by higher digital and e-banking transactions. Trading gains climbed to 77.2 billion, while other income fell to 85.8 billion from 577.4 billion, following the normalization of FX revaluation gain. The bank's operating expenses rose to 365 billion, leading to a 26% drop in its pre-tax profit to 900.8 billion. Its profit after tax fell by 36% to 699.6 billion, with an earnings per share at 20.71 naira. GTCO's total assets increased by 13% to 16.66 trillion naira, supported by loan and deposit growth. After the break, return with updates from the market. Stay with us. Okay, let's move on to market updates from yesterday. Yesterday, the market closed a bit marginally. It was a marginally bearish movement yesterday in the market, as we saw a 0.09% decline. With the market, the all-share index is still within the 155,000 mark. We saw the market lose around 142.95 points. Market capitalization declined slightly to 98.6 trillion naira, and our total traded volume for the day 525.4 million shares. In terms of value, 25.4 billion naira. Now let's move on to the top gainers of the day. The top gainer of the day was Sovereign Trust Insurance, that saw a 9.88% share price appreciation as its share price hit 4 naira 45 kobo. ASO Savings and Loans continued its bearish movement, 9.72%, as the share price is now at 79 kobo. Beggar Paints up by 9.25%, share price 42 naira 90 kobo. Coronation Insurance, WAPIC, 6.90% with the share price now at 3 naira 10 kobo. ICO also saw significant gains, 6.13% to hit a share price of 3 naira 98 kobo. On the losing side, we have Mick Nichols down by 8.81% to close at the share price of 3 naira. Lasako Assurance down 8.62% to close at the share price of 2 naira 65 kobo. Livestock Feeds, 7.69% decline to close at the share price of 7 naira 20 kobo. John Holt down by 7.69% to hit a share price of 6 naira. Ikeja Hotels PLC down by 7.32% to close at the share price of 19 naira. And in terms of actively traded stocks, we see Sovereign Trust Insurance also being the most actively traded stocks in terms of volume, 42.645 million shares in deals worth around 187.29 million naira. Fidelity Bank for almost 42 million shares in deals worth around 797 million naira. First Holdco, 37.7 million shares deals worth just around 1.19 billion naira. Zenith Bank also recorded a significant trading value and trading volume, 28.142 million shares in deals worth 1.8 billion naira. Then Stanbic was the most traded share in terms of value, 27.509 million shares in deals worth over 3 billion naira. Let's look at the global market. On the side of the global market in the US, it was all greenish yesterday. It was all bullish yesterday from Dow Jones, as investors are reacting to what will be described as tempered inflation numbers in the US. Inflation numbers in the US will end up to 3%, although lower than expected of 3.1. The market is responding to that. Dow Jones up 0.73%, S&P 500 up 0.42%, Nasdaq Composite up 0.95%. From there, we'll move on to Asia, where we see it's been a marginally flat, marginally bearish run in Asia. Nikkei 225, after hitting all-time highs, crossing the 50,000 mark in Japan, it went down yesterday by 58 basis points. The Kospi index also crossed the 4,000 mark, and it went down yesterday by 80 basis points. And in China and in Hong Kong, rather, saw a 33 basis points decline in their stock market with the Hang Seng index. Let's move on to Europe, where it's been a mix from England to France to Germany. 44 basis points in England, 27 basis points in France decline, and we see a 12 basis point decline in Germany. That's the DAX index. And that's all we can take on economy and market for this morning. Thank you for staying with us. I'm David Olujinmi.